Diana, it's great to see you again.
Thank you very much.
Do you share Patrick's view that the opportunities for growth are greater in the U.S.?
I do. I think the Canadian market is a little less diversified than the U.S., and given where we are in the growth expectations, I think that there's a more varied and diversified opportunities in the U.S. In Canada, you have to be a little more selective. Our markets are, like I said, a little less diversified. Financials, energy, and single story. Some are wonderful. Freshie came to market last week, one of the better consumer growth companies. But yeah, in the U.S. you have the technology part is very important. There's lots of moving parts and growth, very big market-changing opportunities in the technology sector, for example, as it relates to cloud. Those are all things you cannot get exposure to in Canada, so it would do well to diversify.
What's your read of U.S. earnings season thus far?
Yeah, it's been fairly good. From the majority of stocks so far, about 70% of market cap reported. We've seen earnings growth about a little less than 5%. Even the revenue line has been a little bit better than expected in terms of beats versus misses or flat. So earnings season has come across well, and we have supportive economic data as well. So.
Diana, where do you fall in the debate of whether or not the U.S. equity markets have fully factored in all of Donald Trump's promises? Do you think that it's trading on longer-term fundamentals of interest rates and inflation, or do you think that a lot of his promises on lower corporate taxes, deregulation, have already been priced in?
I think just looking at where the market is trading, we have NASDAQ at a new high and S&P skirting a high. I think that the market is pricing in positive outcomes. Now, you are subject to daily barrages of conflicting and potentially troublesome headlines, yet the market is focusing on the economic fundamentals. That would be earnings repatriation, tax holiday. It would be taxation, favorable taxation. And I think that this very big deal is this stopping the increase in regulation and potentially revamping or rethinking or just balancing act. I think that's what the market is pricing in. I think that it's what the market's telling us, given that it's not selling off on daily headlines and what's happening in Europe, for example, in terms of centrist and leftist potential tendencies. France has an election this year. Those could all potentially could have derailed the market from where we are right now. But I think that the rate increase or the no longer weaker rates, just normalizing the economy, I think that that's holding the equity markets up and buoying expectations going forward in terms of companies going back to growing the proper way.
We've just had the second quarter, this is back-to-back quarters now, of trade surplus in Canadian merchandise trade, driven entirely by energy prices and energy exports. Do you see that trend continuing?
So there is a tug of war between what's going on in energy. This morning, Wall Street Journal running an article on how there's so much long speculation on oil, and yet oil is kind of range-bound. Oil being range-bound is excellent for companies. They can plan, they can hedge, so the stability is great. I think that in terms of the fear, the gentleman mentioned Trump's policies. I think the trade issue as it relates to President Trump's headlines is what's the most fearful in the market. But I think Canada may actually benefit from a friendlier U.S. U.S. actually is less friendly in terms of trade to other nations, and U.S. will need allies. I think that Canada could very well benefit and continue the trend that you mentioned.
Lastly, let's jump to the tech space. You like Apple, you like Microsoft. Why?
Well, cloud, just for context, currently is about a $12 billion market. Some expectations, very lofty out there, that within 3 to 5 years it might be an $100 billion market. Microsoft reported earnings that were fantastic. In terms of the cloud space, which is not, it's growing, but it's not huge yet. They actually increased, and the commercial cloud gross margins went up by 200 points to 48%. The business doubled. And in terms of Apple, expectations were very low going into the quarter, just by looking at a very small amount of chain companies that sort of warned or spoke of softness. And the company reported great number. This company is still growing. It's not going anywhere, and it has a lot of cash and in forms of dividend and buyback and product and innovation to return to shareholders.
Diana, thank you very much. As always, great to see you.
Thank you very much for having me.
Diana Avigdor is head of trading at Barometer Capital Management. She joins us from the TSX market site.